And then Mike Rafferty, who's come here from, by way of Boston, but who's come here from University of Sydney, and has done some of the most exciting work on finance and derivatives with Dick Bryan. Great book that they've done, and they're now working on a book that's trying to integrate the question of finance and derivatives into how this affects labor markets. And Mike also does a lot of work with unions on education, analysis, and training.
Well, thank you very much for the invitation, especially thanks to Kevin and the organisers and sponsors of this event. It's a pleasure to be here, and I've been following a bit of it as it's been posted, and it's been a really exciting event, and should be congratulated for taking up this challenge. And it's a big honour to come along, and hopefully it is, as other speakers said at the beginning, of something more sustained. Maybe at this point too, I'd like to say thanks and congratulations to Sam and Leo. Most people would know that Sam and Leo's reputation carries far and wide, and often meet people in Australia who've been influenced or met them. And of course they recently won the Deutsche Prize, which is a big honour and I think richly deserved. And in fact, sort of in the spirit maybe of their achievement, this is the work, this paper is conceived slightly in that spirit, although you'll sort of see it paradoxically, perhaps. What I really like about Sam and Leo's work is that they've tried to focus on the key expressions of capitalism's frontier, in this case, empire, and the crucial role of the state, the US state, of course, at all sorts of spaces and scales in the expanded reproduction of capital. So this paper is going to try and look at frontiers, and it's based on work that we've been doing for a while, Dick Bryan and I have been doing. And I'm reminded by Kevin, who said that Dick did come here a few years ago and gave a talk and said something like that he hasn't come all this way not to pick a fight. So I'm going to try and be provocative. I don't know whether I want to pick a fight, but we'll see how that goes. Our conception then, we've been doing some work on financial derivatives, which I'll talk about. What we want to do is to locate the frontier of capital accumulation, not out there, but actually in the household. What we're trying to do is to take some work we've been doing on financial derivatives and say that logic, which we'll call the social logic of derivatives, that the household is at the frontier of these developments. Now that sounds a bit paradoxical, and in a way I don't have all that time to sort of develop the argument. So what you'll get is a series of propositions, and then we can sort of talk about them a little bit later. And I don't want to, since I'm here in Canada, I don't know that much about Canada, and the pages have been fantastic, both politically and also the empiric, so you don't really want to hear too much about Australia. All I'll say as a way of background is that Australia is quite advanced in its restructuring and retirement. I mean, in some ways, you might say it's the poster child of the World Bank's long-term project. So, for instance, we have a mandatory 9% of everyone's income goes into compulsory super schemes. They're privately managed by financial institutions. There's currently, depending on how you measure it, about $1.5 trillion. Our dollar's pretty similar to yours, so you can make that, which makes Australia about the 5th or 6th biggest fund management industry in the world, and this is all, more or less workers' savings. So, along with high household debt and a high property ownership, Australia is in some ways a very highly financialised country, and that's helped us, I guess, helping to frame this. So let me get to financial derivatives and then how this financial logic has started to impact on households. The starting point, I guess, for our analysis then is that finance, we all know it's become a big industry. In some ways it's an industry now that could rival the car industry of the early 20th century. But that's not our key concern, not just that it's big. What we're trying to understand and identify and develop some sort of analysis of is the fact that finance, the calculative logics and ways of being and what it's asking, is actually leading finance into all sorts of other places. It's blurring boundaries, it's changing our understanding of all sorts of things, capital, class, and competition. And in this paper, what I'm trying to do, just to repeat, is to try and identify how that sort of logic is now involved in all the sorts of restructuring, including retirement, and so that finance and risk are now part of our daily life, and this derivative logic can be seen to be driving it. So, a little bit about derivatives. I'll try and do it in 2 minutes. So I'll start with Bretton Woods and finish up with Moneyball. Here we go. One of the things about derivatives, and I guess it's probably worth thinking about it, that for derivatives have been around for a long time. You know, Aristotle talked about derivatives, and for a long time, derivatives were really confined to the sleepy realm of storable agricultural commodities. But something happened around the 1970s to change all that, and Bretton Woods was one of the key moments in that transformation. So what happened? When you no longer have fixed exchange rates, companies that are accumulating across different countries are suddenly exposed to the chance that the exchange rate may move against them. Now, while it wasn't predicted, because deregulation was expected to stabilise exchange rates, as it turned out, financial derivatives could be developed so that you could extract that risk, the risk of the exchange rate moving in an adverse way, and you could turn that into a commodity which could be traded. Let's call it insurance. So that you could insure against the chance that exchange rates may move against you. Now, in itself, it's rather a banal development. But the point about it is that what's happened here, almost without us noticing it, is that an attribute of capital, in this case a risk of an exchange rate movement, has been separated from the underlying thing. Let's say we're selling wheat internationally. It's been separated away and turned into a separate commodity. If you like, a bit of the capital has been unbundled from another part of the capital. Now, as it turns out, there are all sorts of volatilities and changes that occur over time and across space that could be seen as risks. And once financial derivatives started to develop, we saw this rapid escalation across all sorts of areas, particularly in exchange rate areas and particularly in other types of financial risks such as interest rates and so on. Now, as this sort of logic starts to kick in, all sorts of other areas start to be reorganised so that, for instance, if I can secure a guarantee that exchange rates aren't going to change, then I can continue to expand internationally. So it's quite facilitative of the ongoing international expansion of capital. But it's further than that, and perhaps the sort of idea here might be seen, although I'm not giving any moral weight to this, in sports betting. So for instance, in sports betting, it used to be that people just bet on the outcome, right? Who was going to win or lose the game. If you think about the contemporary world of sports betting, all sorts of attributes of the game now are unbundled. For instance, who's going to score first, how long before the first score, the spread between the winning and losing team, you know, which players score first, who scores. In a sense, these are sort of part of a derivative. You can see this exactly like a derivative logic, so that these attributes of the game, not the end result, can be just as much a part of the gambling phenomenon, and it's really just the imagination of the gambling agencies and the liquidity of bettors that determines how many sorts of bets you can have on a single game. And of course, we come to Moneyball, that book about baseball. And here, the idea of the derivative logic was that instead of people knew that they couldn't, this team didn't have enough money to get all the good players. So they got some derivative traders to think about the attributes of different players that they could put together, and then put all these different attributes together and find a team that would get the sort of metrics that would get them to the playoffs. And it was no surprise that in a sports game, it was derivative traders that were able to think about the game in this sort of abstract way. And of course now, in financial markets, derivatives now represent the largest set of financial transactions in the world and that have ever existed. So they're big and they're also transformative. The question then is, how do we get to a social logic of derivatives? Right? So far we've explained that they're functional for capital in their relations with each other. What we're trying to do in this project is to think about how derivatives are, in a sense, helping capital to reimagine labour. And in fact, not just reimagine it, to restructure labour. So, we've come to the idea then that derivatives allow us to deconstruct a thing into a set of constituent attributes. What we can see, and I'll go through 3 of these developments in a minute, is a series of both changes in finance and financial institutions and related changes in society which are feeding off each other to make finance not just a calculative project for capital, but a major force in the way in which capital-labour relations are changing. So let me get to the 3 changes. And the way of organising this sort of thinking is to think about the way in which labour and capital conflicts and contests are about risk. Before I get to that, just in case you think that this idea that risk and risk transfer that I'm just about to talk about is something that's been dreamt up by a couple of lefties, let me just make a couple of points. The current round of Nobel Prizes for Economics, so-called, included a guy called Robert Shiller. Now, Robert Shiller's interesting. He was nominally given the award because he found out that financial markets have behavioural attributes, right? That sometimes they get moody, sometimes they get, as he called it, irrational in their expectations. But I'll put it to you that Bob Shiller, in sort of historical terms, will be remembered far more for the idea of a couple of points that he's made. The first is a recognition that he made several years ago. And he said, you know what, when we think about financial markets, everyone thinks about the stock market. He said, that's irrelevant. Far more wealth is located inside households than in the stock market. And that, in a sense, the project for finance is to find ways of unlocking the wealth that's inside households. Now, he didn't just predict, as Dick would say, he didn't just predict the future, he's been patenting it. He's got a whole set of financial derivatives that are based around households. So, for instance, there's something called the Case-Shiller Index, which is an index of suburb by suburb of property prices. That index then could form the basis of you being able to insure against your property going down, as you lose equity on it, and so on. He's got a whole bunch of income protection type derivatives and so on. The World Bank, several years ago, was restructuring its whole social policy project, which is now, by the way, called social risk management. That's the overarching concept that drives the World Bank's vision. And they said explicitly that over the last decade there had been a shift of risk from the state to households, and that financial markets instruments have been critical to facilitating that. And the most famous example, of course, is the IMF, which in 2005 said that the financial system, in the global financial system, had got so much better because it had shifted risk to households who were now the risk absorbers of last resort. And this made, because risk was now dispersed, it made the system so much safer. Now that was in 2005. Now, the point is, this project is not one that has gone unnoticed by the state and by capital. It's been, in some ways, conspicuous and conscious. And the sort of strange thing is that it's taken a long time for us on the left to just recognise the significance of these changes. So, the proposition then is that if we look at risk in 3 dimensions, we'll see how our social life is increasingly being calibrated by financial competition. And that's the project of capital, which is to transform our lives so it will be in harmony with that process of financialisation. So let's have a look at the three risks. The first one will be familiar to you. It's the shifting of risk from employers to workers. This process has been going on perhaps since the 70s, but we'll note a couple of things because it's also significant in a couple of ways. Because for most of the 20th century, in a sense, the social contract at work was that as social productivity grew, living standards would gradually rise, right? Now, the promise was never that we would be in abundance. Abundance was always going to be somewhere further off, right? But so scarcity was the current condition with abundance as the potential, the future. And if you like, the down payments of which were gradually increasing living standards. But from the 1970s, that all started to change. And in fact, you might say the whole project of that potential for abundance has been inverted. In fact, the risk of future scarcity is why we must defer any contest about abundance. And we'll talk about that in a minute. But the discernible changes in employment, the ones we all know, the move away from full-time employment, the way from secure jobs to casual jobs to part-time jobs, the reduction or move away from lots of conditions, the collapse of the DB schemes into DC and so on. We've seen a series, if you like, of iterative changes. Each one of those changes can be seen as moving risk from employers towards workers. The calculus now that employers are trying to make with labour, all right, is to try and get exposure, just like in financial markets. The key project then is to try and gain exposure to the performance of labour, but minimise the exposure to the things that they don't want from labour, right? So they don't want to make long-term commitments. They don't want to have exposure to a DB plan that sets them up for market risks. So it's a matter of, in a sense, reconstituting the employment contract so the employer gets maximum exposure to the performance and minimum exposure to any of the risks of the labour market. That's the derivative calculus at work. The second shift of risk is also familiar, although probably not talked about as such, and that's the risk shifting that's going on from governments to households or to citizens. We can think of privatisation, the PPPs that we talked about, the commercialisation, the changing terms of access to education and health via insurance or fee for service, and calls for growing individual responsibility and workfare, all as forms of risk shifting from the state to households. Even in terms of how states do things now, there's a growing reorganisation of the logic of the state into things like how might the state simulate market motives of calculation in organising and delivering services. And probably the leading edge of that, something that I think Kevin mentioned, the so-called social benefit models, where not only will the state contract with the private sector to do things, that the form of payment will be via a capitalised bond, which fortunately, because it's of such social benefit, pension funds can then invest in.
Social impact bonds.
Or social impact bonds is the other way they're called. And the final area of risk shifting, which sort of consolidates the two, is a shifting of risk from financial institution and markets towards household. This is probably the sharpest edge, especially given what happened with the subprime meltdown. But if we look further back, as some of the earlier papers have done, we've seen a shift from banks, which offered lines of credit, to financial services institutions, which might offer a range of services. So it's not just bank loans. We've got insurance contracts and all sorts of other services that get bundled together, along with the growth of things like financial advice. It's a recognition that with the shifting of risk at work and from governments to households, there's a massive space in which workers need to manage their risks and financial institutions have moved into that space to do so. The point is that in combination, these risk shifting have left individuals and their families open to intensified financial market calculation and inevitably expose them to financial markets and their volatilities. So the self-employed contractor who has to borrow money to get tools or to take out income protection insurance is now almost forced. There's no choice to be involved in financial markets. You're inducted into them. Students that graduate with large student loans, in a sense, are graduating into a financialised world, and so on. And of course, households are uniquely positioned because they are perhaps the only institution that can't transfer their risks onwards. Right? So in a sense, the IMF was right that they are the risk absorbers of last resort. I'll move on. I'm going to come to some provocative comments in a minute, or propositions, but I just wanted to say, if we think about this new development, this development in which, if you like, the derivative has become a social force, not just a financial force between capitals, what spaces does it open? I'll come back to it in a minute. I think we got a glimpse, at least, of some of the potency of this opening, only in its negative form. The collapse in 2007 of the subprime market, in its negation, just shows you the scale on which financial markets now are integrated into households. And the collapse of those households really was of world historic significance, not just because of the scale, but because it shows for the first time that households are now the corner of financial stability. You know, the sort of, you might say, the innovations that have been occurring in central banking over the last 5 years have been about recognising the key role of households. The project of central banking now is monitoring households in order to regulate financial stability. So if you have a look at any central bank, have a look on their website, and they have these things called household balance sheets. And there's a whole econometric project about trying to work out how risky households are, how vulnerable they are, because they realise that financial stability now rests with you and I. Us being reliable payers of all of the fixed commitments that create asset-backed securities and the loans and so on. So, this is the development then, I guess, and I guess there's a sort of historic call, but let's think about it. Households and labour in general now have three critical engagements with capital. The first is a provider of wage labour, and we've seen that in a financialised world that's become increasingly precarious and risky. The second is as consumer. Now that goes back, of course, to mass production, so it's not new. But what's changed with financialisation is that there's a growing range of financial products that fit inside the consumer basket. As the world's become riskier, we've had to take out more and more, and even things like telephone contracts and so on, which are now the base of all sorts of asset-backed security. By the way, I noticed recently that Standard & Poor's have put out a report saying that the securitisation of car loans now has already exceeded the peak of 2007. And when asked why asset-backed securities like this have grown so rapidly again, the answer was, from market participants, it's pretty simple. Households are seen as less risky than many of the sovereign governments like Greece, Spain and so on. So money is pouring into asset-backed securities as markets have started to realise that households are less and less risky. And we can expect that in many of these other markets, student loans and so on, that this is going to come back. The third relation with capital, and I think this is the most controversial, and we've used an ironic term, but it's that labour and households now are major providers of assets which underlie asset-backed securities. In fact, we've ironically called this dimension of labour as an asset class. But in all three of these areas, they all need to be seen as relations of production. But in a sense, the second and third conceptions of consumer and asset class we also need to rethink what we mean by production and circulation. From the perspective of households and of labour, the first one is the most important, work, which is the means to income. But for capital, all three of them are just as equally important. Right? They're just as important for capital that we remain reliable repayers for the asset-backed securities and reliable consumers and users of insurance and other products. The trouble is, and these are picked comments, in some ways inspired by a lot of things that Sam's had to say, trade unions, unfortunately, just remain locked in a politics of resistance to capital based on wage, labour and work. Right? We've talked about capital's expanded embrace of labour and households, but the trouble is the politics of resistance has remained largely fixed on the labour market and work. Our argument is that the wage relation should not be given this privileging, and political organisations like trade unions will do so at their peril. And in a sense, I know Sam called what's been happening a historic defeat of labour, of organised labour. Our conception perhaps would say that the challenge really is that organised labour is being transcended by capital's expanded embrace of labour beyond the factory. And that's something that we need to talk about and think about. That's the frontier of capital. I'll just say a couple of words about class and then I'll do a quick little recount and finish off. So, traditionally the concept of class has related to our relations of production, right? And that sort of made sense. It was always a proxy because, of course, we know the class relations had all sorts of impact well beyond the factory. But we allowed it as a suitable proxy for certain reasons. But what about in an era when workers own capital, as they do in pension funds? That's extending beyond the employment relationship and into the domains of finance and financially linked consumption. A proposition that we put then is that class relations can no longer be adequately defined only in terms of wage work. If we do so, we'll just be subsuming that process into the way in which capital's transferring risks to labour and households in lots and lots of ways beyond the factory. So, if you like, the proposition that we put here is that the class project for labour is to address the ways in which we can give real unity and purpose to labour in all of these spheres, not just at work. In a sense, we have to respond to this historical transcendence or this expansion. So where does pension funds fit into this story, and then I'll finish. I think the point that I would start with is to build on Chris's comments of several weeks ago, that we need to understand that the financialisation of retirement has not given workers new ways of confronting capital, but it's helped the development of financial markets. How we develop a politics which takes that challenge up is really the open question. But we need to accept, I think, that so far the financialisation of retirement has been an absolute boon for capital, and in a sense has given it even bigger visions about possible futures for labour. In other words, the frightening prospect is that this financialisation of labour, we may only be at the beginnings of this process. I just want to come back to a key turning point in the financialisation of retirement. It was a report done in 1994 by the World Bank. And that report, although there'd been many reforms that had started the move towards retirement privatisation or financialisation, that was a key moment. That report, which was a document prepared by the World Bank, but also had lots of sponsors, especially USAID, and there's a fabulous little study of this by a guy called Mitch Orenstein, no left-winger, but he called it the International Project to Privatise Retirement. It's worth a read. The key point there was that, in a sense, it was a cynically developed report which said there's a looming ageing crisis. That looming ageing crisis will translate into a fiscal crisis if nothing is done. We must restructure retirement financing accordingly. You know, the irony, of course, of which is that, you know, James O'Connor used a looming fiscal crisis to sort of, you know, invoke a left socialist project, and it was the right that effectively sort of, you know, turned it on its head. Now look, that project, this idea of a looming fiscal crisis and an ageing crisis, is still one that people sort of intuitively think, yeah, that's right, isn't it? Ironically, it was that report was subject to incredible critique by people like Nicholas Barr, Peter Diamond, who himself was a Nobel Prize winner, even Joe Stiglitz got stuck into it, right? But they said it was a myth, largely red herring, that there is a demographic issue, but there's nothing that invokes a fiscal crisis. And in fact, Estelle James, who was the lead author of that report, pretty much conceded that later on. Let me just give you a couple of quotes, because a couple of years ago she wrote a sort of retrospective, a sort of Machiavellian account of how do you privatise retirement financing, and it's sort of a view from the World Bank and Latin America. Under the section of this document, strategies for overcoming opposition to structural reform, i.e. pension privatisation, she's got in the heading, of course, there were three potential institutions, one of which was labour unions. And let me just read you what Estelle James said several years ago. There are several reasons why labour unions may resist reform. We won't go into why, but here's a, and this is the Machiavellian project. So, okay, there's reasons why. What do we do? To some extent, the reform can overcome the opposition of unions by giving them a new role to play in the system. And then she goes on to say, you know, maybe some co-governance of a few funds would be the project. I don't know about you, but in Australia, that has a really scary implication, because that's pretty much exactly what's happened. So let me finish then by recapping. We started off by saying that the development of derivatives in the early 70s in particular, financial derivatives, started off as a way of unbundling attributes of capital as a way of ensuring against volatility. At a certain point, however, this logic became so profound that it's found its way, and it's now becoming a premier organisational force in the restructuring of relations between capital and labour. And we're calling this the social logic of the derivative. I think Randy Martin is another person who's been working in this area, you know, does some extraordinary work. If you get a chance, have a read of some of that. We can see this most clearly in the increasing risks borne by labour across the spectrum of employment and the state. It's changing class relations quite profoundly, and making, in some ways, some of the older institutions of organised labour perhaps obsolete. Our argument is that we need to see it, to name it, and to begin to work out how capital's expanded embrace of labour can form the base of a different politics and resistance. Thanks very much.